Hi, it's Arjun with a bonus Super Spiked video podcast on a week we were expecting to take off due to a college drop-off, but last weekend we couldn't resist digging into trying to better understand why have crude oil prices been so resilient in the face of unexpected OPEC quota increases and generally lackluster economic perspectives. Against that backdrop, crude has been totally hanging in there. And I think our punchline is that while we agree that there is some risk of softness in the back half of this year and early 2026, underlying crude oil only, keyword that we'll come back to, crude oil only supply demand balances are not anywhere near as bearish or oversupplied as I think consensus fears. And that fear of sort of a crash and even the risk of an extended downturn, I think those fears and risks are way overdone, even if we do have some softness in the back half of this year. And we are frankly gaining confidence that by the time we get to the middle part of 2026 and 2027, oil price risks are starting to shift to the upside. Now, the main points of difference are one, to disaggregate black crude oil from the more widely used and followed overall liquids number. We are guilty of as well. When people say oil markets, they're often really referring to total liquids, which is black crude oil plus NGLs plus biofuels and others. And you got to disaggregate these things. I think the second key point of difference is to give greater consideration to OPEC Research's monthly oil market report versus the more broadly used, almost everybody bases their supply demand outlooks on the IEA's equivalent oil market report. And we spent, as you know, the past month examining the long-term outlooks from the OPEC Research, the IEA, and other major oil companies and forecasting agencies. And we, of course, have concluded that OPEC Research's view actually looks the most realistic and pragmatic of all these major forecasts out there. And they're sort of least guilty of having succumbed to that sort of net zero or energy transition mindset and ideology of the last 4 to 5 years. Now, that doesn't mean that OPEC Research is necessarily going to be right or better at short-term forecasting, but they certainly shouldn't be dismissed or ignored either. It would be the point. Now, as a reminder, at Super Spiked and at Veriton, our focus is on the long-term outlook for the energy macro, markets, and company strategy. We have zero interest in trying to jump into the short-term oil price guessing game that frankly others are better at and most of the street tends to focus on. But in this case, the prevailing narratives have been so bearish for crude oil and really at odds with how the markets have trading or our own sense of the balances. We did think it was worth at least making this video and wading in here a little bit. Now, it remains our view, make no mistake, that from the perspective of prudent risk management, whether you're a corporate or investor, our super vol mindset says you always have to be prepared that you can always see $50 oil for a 12-month period. We're not suggesting one should throw out prudent risk management with these kind of comments. That is a normal trough, always at risk in a super vol kind of world. But the idea that we're going to have a severe crash and perhaps even an extended downturn, that is what we're pushing back on. And it's as important from a corporate strategy and an investor standpoint to think about what does a balance of risk look like? What is the prospects for potential upside, especially as we get further into next year and the years after. Now, we are producing this video as a final point of warning a week before publication. That's always dangerous. So if there was interim news flow that's meaningful, I guess we can always pull the video, but it may not reflect developments over the course of, August 18th to the 23rd. So let me start with some of the high points on really why we think there's such a difference between the very bearish consensus narratives about oil markets and what we think are somewhat healthier balances. And the first point we'd make is almost everybody starts with the IEA's flagship oil market report as the basis for the oil supply demand modeling. So we'll start with that model, and then people will often make tweaks for their own economic outlook. Perhaps they have a different view of US shale or Russia production or OPEC developments. But the baseline is usually IEA with then tweaks made by this. Again, I'm going to say this is how most of the street does this kind of stuff. And I think everyone, and we are guilty of this as well. When we say oil markets, we're often talking about overall liquids. So for example, if people say the oil market is 100 or 105 million barrels a day of supply and demand, when you're using a number like 105, you're including not just black crude oil, but natural gas liquids, biofuels, and some other items as well. And in round numbers, crude oil today, black crude oil, is about 80% of that liquids number. Natural gas liquids, which have been growing at a fast rate, is about 15%. And biofuels and others, which have also been growing fairly meaningfully, are about 5%. If you went back 20 or 30 years, crude oil would have been 85% of that total. So there has been a gain in share in NGLs and biofuels, and that does impact these overall liquids balances. When we're talking about crude oil prices, what you will see on the screen, WTI and Brent, they are driven by black crude oil. And while it is true that things like ramping biofuels or ramping NGLs can take away in part from some of that black crude oil demand, one should explicitly account for it as opposed to kind of being loose. And we're guilty of this. We're not trying to say we're totally innocent here of differentiating between, again, this liquids figures and really black crude oil. We've also observed that it became really noticeable in 2024. It's kind of true over the last few years, but especially since 2024, there's been a growing divergence between the IEA's oil market report and OPEC Research's monthly oil market report. These are the two flagship reports that we think most people focus on. And whether it's demand growth, the absolute level of demand, even non-OPEC supply and OPEC crude production, these numbers used to be much closer between these two key agencies, again, OPEC Research and the IEA. They've been diverging, and they've been diverging in favor of OPEC Research, generally expecting somewhat tighter markets, the IEA generally calling for looser markets. And again, this over the last 2 years. And I'm going to show a picture here in a second. If you look at the forecast that the IEA provides for demand and non-OPEC supply, and then use some notion of current or expected OPEC production, you get really large implied liquids bills using the IEA's oil market report, especially in the second half of this year and the first half of next year. Though, quite frankly, there were some large implied bills in the first half of 2025, which oil markets generally did better than what those bills would have suggested. And I think if you look at what we've tried to do, and what we'll show again in the next graph, and the only graph, is if you look at OPEC's monthly oil market report and get down to a crude oil only balance, you end up eliminating a large chunk of those inventory bills. You don't eliminate all of them, as we'll show, but you end up with a much tighter, or certainly far less oversupplied market than what is implied on a liquids basis from the IEA's oil market report. Let me show the picture. Hopefully it'll clear this up further. So here's a picture of implied inventory bills using either the IEA's oil market report, which is the red bars, or OPEC's monthly oil market report, which are the purple bars. And maybe I'll explain the graph first before going through some of the key differences. So this is quarterly implied inventory build. If the number is above zero, inventories are building. If it's below zero, they're drawing. The IEA, we're using the liquids number, which again is how I think consensus generally thinks of oil markets, especially when they declare they're bullish or bearish or neutral. For the OPEC, we've then taken the liquids, their equivalent liquids numbers, and turned them into crude oil only figures. If you did that for the IEA, you would still get much larger inventory bills, just to be clear. A couple other key points to note from an assumption standpoint. We are just using the IEA's figures that they've published in OPEC Research's figures. None of this reflects a Veriten or SuperSpike view of where supply demand might go. We do keep our own models. We don't publish them. We're, as we noted, not into the short-term price guessing game. But to be clear, these are our IEA and OPEC figures. The one assumption we did need to make for both of these two reports is that neither projects crude oil production. So for 3Q 2025 to 4Q 2026, we are using the July reported production figures that the IEA reports for its balances, and then we're using it's a different number, but the July production number that OPEC reports in its balances going forward. So certainly on a personal view, or any of you could say that, hey, OPEC production, whether it's the IEA or OPEC research, it's going to be higher, or you might think it's going to be lower. You may think sanctions are going to come in. There are lots of different things that could happen that could cause these balances to vary. As we know, you could have a change in economic conditions. There's lots of risks and caveats one could attach to this. What we wanted to show here, and the point we're trying to make, is if you look at the IEA's oil market report, it is inferring a really bearish outlook. Frankly, a more bearish outlook than we saw during COVID, which was pretty darn bearish. And to me, that just doesn't feel right or match with what I think we're seeing in actual markets. And I would observe, if we look at the black crude oil only balances within OPEC, it is still assuming some softness, especially in the middle, some inventory bills, but more modest inventory bills that frankly, the noise of is demand or other OPEC supply higher or lower could easily make that a little bit worse or frankly wash it away. If we look at some of the key differences, the variance, the net difference, those big negative green bars, what that negative green bar says is that OPEC's balances are inherently much tighter than the IEA's by that amount. And there are four key areas where that we've adjusted for. One is OPEC is more bullish on overall liquids demand, both on an absolute basis and a growth basis. They have less robust non-OPEC supply, again, both on an absolute and a growth basis. And their absolute levels of OPEC production are lower than the IEA's. And those three items add up to kind of let's just call it a bullish variance for OPEC research relative to the IEA. But there's one important offset. If you look at refinery runs, OPEC research actually has lower crude oil refinery runs than does the IEA. So there's one offset to their otherwise three directionally bullish items, and that is refinery runs. As you all hopefully know, the only people on earth that actually demand crude oil are refineries. So we think of refinery runs as essentially crude oil demand. The other key components of your liquids balances, it is crude oil plus natural gas liquids plus biofuels and other equals overall liquids. And as we just noted, we are as guilty as anyone of short-handing oil markets to be liquids when it is really important to disaggregate black crude oil out of it if it is crude oil prices that we're now forecasting. Most of these times, these things aren't as noticeable, but right now, these red bars, which I think the market is fixated on and is causing people to say, hey, oil markets are going to crash to below $50 a barrel, and maybe they're going to stay there for an extended period of time until you clean it up. We're going to conclude that that is way too bearish of a conclusion and interpretation. Even if OPEC research, even if they are too optimistic, to me, they are directionally much closer to the truth is what we're concluding than I think the IEA balances will imply. Time will tell, as they say. So I'll end this video on a personal note. And we made a choice this weekend. We could have played a round of golf with the buddies, 9 holes with the wife, and gotten in some practice time. Or we could have spent time diving into IEA OMAR versus OPEC MOMAR, liquids versus oil supply demand balances. And we chose the latter. It is a beautiful weekend here in the US Northeast. Now, I did go to an awesome Dark Star Orchestra show at Pier 17, a fabulous place to see a concert if you ever get a chance. I was able to see my parents take me to my aunt's place for dinner on Saturday night. So we think our good share of family personal stuff. We did sacrifice some golf to analyze crude oil balances. The question is, did we make the right call? Well, the test is going to be next Friday when, after we return from college drop-off, we have our Final Four President's Cup match. So I did get in some putting practice. The 9 I played today was actually not too bad. So we're gonna knock on wood. We're gonna hope for the best, and we will report back on whether we made the right call here on golf versus crude oil analysis. Thank you.